Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. Roll time. Good God. We can't look at this, guys. Like my strategy is, you buy it and you hope that you get excited. Yeah, but we all think you're crazy. You don't fight this. No way. So the markets are freaking out and you don't think that anything will be wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It is Thursday. This week is going by fast. I have done so much this week. Man. Well, we got the ECB meeting. Big deal. Let's come over to the charts. I'm trying to find my chart. Oh, there it is. I found it. Cool, I found it. Don't worry. Hey, so what have we done? Well, we have continued to move down overnight, and here it looks like the ECB is hawkish. I'm kind of wondering if it's not as simple as just sell and, hold it today. I don't know. I do think this ECB meeting likely to be hawkish and likely to push interest rates down further. 10 years at 3.07 right now. S&P 500. It's doing okay yesterday. They did close above the previous day's high, and it's looking okay. We'll see. They haven't really moved a whole lot overnight. We'll see if they're able to continue this rally or if this thing falters. We are right at the 50-day moving average. We come back over here, S&P 500. We're really close to it, so we might hold it for a little bit and then come back down. That's happened a couple of times to us, right? Oil taking a little bit of a dip this morning. Natural gas. I don't know what to say about natural gas anymore. The thing is that what we see here in natural gas is very disconnected from the natural gas that's going on in Europe. So, gold and silver destroyed again. Oh man. Even with the dollar, is the dollar coming off, or is the dollar still looking strong here? Well, the ECB meeting is going to hurt the dollar. Actually, it is a little bit stronger than it was yesterday, but they're well off their highs. And then we got the Bitcoins. Well, Bitcoins on the way down and making lower lows after a pretty okay 2 days previously. So that's where we're at. What's this? Oh, that's interesting. Oh, but you know what? I can just remove those from this list now. It's basically telling me that it can't, that the way Rhythmic retrieves the micro treasuries is a little bit different. So we'll just fix that. I am still having this problem here in Jigsaw where the instrument settings are incorrect. I did get an email from them like we're looking at it, but nothing has happened since then. So I don't know. Is something wrong with my DOM here? Because that's not correct, is it? Yeah, I don't think that that's right. So it says that I've traded 42,000 right there. What? What's going on? What is this? Why am I having so many problems? This is funny. I've never had these kinds. I've always been the type that I just have explored into so many things that I've run into every kind of issue there is, right? But this week has been particularly bad. Yeah, disconnect and reconnect. Well, let's just restart Jigsaw here and see what that does, all right? Unpin that. And can I pin this one? No, I said unpin it. Stupid head. Cancel. Fetch. Unpin. But then I have it over here. Oh, well, let me pin it over here. Okay, whatever. Meanwhile, over at the ECB, okay, they have not started that yet. Oh, do they start it? Oh, in 45 minutes is what it's telling me. Okay, fine. Did they just say something? I'm looking at my data and it looks like there was a pretty jolting reversal here in the treasuries. Oh, okay. So I forgot. Jobless claims up 7K to 251,000. We're looking for 240, so that's 11,000 more than expected, and the Philly Fed Business Index was very poor. So that slate of data was I'm going to say a step worse than the previous ones in it. Could be something to get them to back off a little bit. That's better. It may have been something to do with like Rhythmic wasn't loaded correctly or something when I started Jigsaw. Okay, so let's read back on Twitter and so forth, see if we missed anything. ECB, of course, raising interest rates 50 basis points. Mohammed A.L. Arian. While the dollar index is somewhat weaker, the currency is stronger against the Japanese yen, consistent with the Bank of Japan's continued resistance, including via unchanged yield curve control, notwithstanding upwardly revised inflation to the global phenomenon of higher rates. It's a global phenomenon, folks. Higher rates. Brannigan Barrett, German curve flatter. There are very few scenarios in which this trade comes unstuck today, and it will become a consensus trade over the next days and weeks. Currently 64 basis points. The more hawkish the outcome today, the faster we get to zero and invert. Let's see here. Gold Delta has been positive last 3 sessions, so whilst prices have been coming lower, buyers are lifting offers. Today, on break below last week's low, we had Delta turn negative, showing stop run and fresh shorting positioning. So my play is simple. I believe 1680, 1700 to be support, and I believe sellers are trapped below 1695. Then once again, we get above 1695, we should see an acceleration and confirmation of a significant low for gold. So I'm entry as soon as gold closes above 1695. Well, you might get that. Gold is apparently moving here. Is that because we're getting another little reversion here in the dollar? Yeah, what I'm seeing here does suggest that the dollar is relatively weaker against the euro, and that could be driving up oil. Bring that all the way back. Ooh, the European Central Bank, they got, their pregame music going, and it's kind of that ambient uh, electronic music that gives you just a little bit of anxiety, very very financial. It's not like the Federal Reserve's music is very uplifting, and but this is kind of more contemplative, and like it's go time, you know is that kind of, what I'm talking about, right? Like it's contemplative music, but it's also like it's like go time it's like you watch it before the big event. They got it going. This is so business. It's so business. I wish I could make business music like this. I need to study this stuff. I need better examples of it, study it a little bit, and make some. Oh, see that just now it just turned up. It's quite a bit more. What do we say? Okay. Dim 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 dim. Okay. Oh, they have a fix. They have a fix for me. Please close day trader if it is open. Then go to your Jigsaw trading database. Okay, so documents, Jigsaw trading database, and delete the Jigsaw trading UNC file. Jigsaw trading.unc file. Then open Jigsaw and download your instruments again, and the issue should be solved. So it must have been that like Rhythmic had the instrument settings incorrect or something. Check out the low of ZF. What happened at the low of ZF? I can see here that the way, unless there's something wrong with my data, it was like the treasuries ran into a hard wall at the bottom. Is that correct? So like, oh man, maybe what I was seeing on my DOM was okay. So like all of my bids and offers were probably screwed up, but it was telling me that there was like 50,000 contracts or something absorbed at 15.5. Is that what you mean, Octavius? Well, we'll be able to see here on the volume profile. Oh, hey. You'll post it in Discord. Okay. 17,000. How much was it in the 10-year? Well, I was kind of thinking yesterday. Yesterday, I was thinking, hey, if we can get our, everything fixed up and feeling comfortable, we might have some opportunities to take some trades here in the ECB. But I don't think I understand what's going on here. There is all sorts of wild and crazy stuff going on right now. So I don't know. I don't know what to do. I think that some of this might be driven by the Japanese yen, because it was like, at first it was like, oh yeah, this means higher rates, but then the Japanese yen started going up. The dollar is like just getting pummeled, right? So like everything in the complex is kind of in line. I would have expected them to go down, but maybe because of the currencies they can't do that. I think I'm gonna come in here and still try to download instruments. CME, reload, download. Oh, 10-year didn't even show up there. No. Wait, hold on. Maybe it's because I need CVOT and CME. Download completed. Okay, I think we're about to start here. Oh, look, that did fix it. Oh, wait, that did 10-year. That I was like, oh, I fixed it. No, that was 10-year. I wanted two. I wanted two here. Yeah. It's still showing the problem in the other ones, so. Jacob, I do not understand why equities are bid, nor do I. This is, I have to say, this is one of the more confusing market moves I have seen in quite some time. It hasn't been that long. A couple, I can think of a couple in the spring that I was a little bit like, huh? But remember, at the beginning of this, I was saying, well, I think it might be as simple as just go long interest rates and short the treasuries and hold it all day. Does not look like that is actually the case, does it? Okay, well, I am going to go to the basic here and we'll put the ECB out.
camera and your microphone, since we want to hear and see you. And with this, I would like to hand over to President Lagarde. President Lagarde, please.
Okay, how is the volume on that?
And good afternoon to all of you. The Vice President and I welcome you to this press conference. Today, in line with our strong commitment...
I think I should pay attention, so I think I'm going to be a little quiet here.
Further key steps to make sure that inflation returns to our 2% target over the medium term. We decided to raise the 3 key ECB interest rates by 50 basis points and approved the transmission protection instrument that I will refer to as TPI. The Governing Council judged that it is appropriate to take a larger first step on its policy rate normalization path than signalled at its previous meeting. This decision is based on our updated assessment of inflation risks and the reinforced support provided by the TPI for the effective transmission of monetary policy. It will support the return of inflation to our medium-term target by strengthening the anchoring of inflation expectations and by ensuring that demand conditions adjust to deliver our inflation target in the medium term. At our upcoming meetings, further normalization of interest rates will be appropriate.
This ECB meeting is a bigger deal than it normally is, so I guess we should probably expect some unexpected moves and bizarreness around things.
Transition to a meeting-by-meeting approach to our interest rate decisions. Our future policy rate path will continue to be data-dependent and will help us deliver on our 2% inflation target over the medium term. In the context of our policy normalization, we will evaluate options for remunerating excess liquidity holdings. We assessed that the establishment of the TPI is necessary to support the effective transmission of monetary policy. In particular, as we continue normalizing monetary policy, the transmission protection instrument will ensure that our monetary policy stance is transmitted smoothly across all euro area countries. The singleness of our monetary policy is a precondition for the ECB to be able to deliver on its price stability mandate. The TPI will be an addition to our toolkit and can be activated to counter unwarranted disorderly market dynamics that pose a serious threat to the transmission of monetary policy across the euro area. The scale of TPI purchases depends on the severity of the risks facing policy transmission. Purchases are not restricted ex ante. By safeguarding the transmission mechanism, the TPI will allow the Governing Council to more effectively deliver on its price stability mandate. In any event, the flexibility in reinvestment of redemptions coming due in the pandemic emergency programme portfolio remains the first line of defence to counter risks to the transmission mechanism related to the pandemic. The decisions taken today are set out in a press release available on our website, and the details of the TPI are described in a separate press release that will be published at 3:45.
Supply chain disruptions, supply bottlenecks may be easing.
I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions.
The second half and beyond.
So, economic activity is slowing. Russia's unjustified aggression towards Ukraine is an ongoing drag on growth. The impact of high inflation on purchasing power
Well, it looks like the treasuries came off there awfully quickly, didn't they?
Uncertainty.
Man, the liquidity is insane on this thing right now.
Tourism is to help in the third
Firms
quarter.
continue to face higher costs and disruptions in
Need to turn off the news squawk there.
There are tentative signs that some of the supply bottlenecks are easing. Taken together, these factors are significantly clouding the outlook for the second half of 2022 and beyond. At the same time, economic activity continues to benefit from the reopening of the economy, from a strong labour market, and from fiscal policy support. In particular, the full reopening of economy is supporting spending in the services sector. As people start to travel again, tourism is expected to help the economy in the third quarter of this year. Consumption is being supported by the savings that households built up during the pandemic and by a strong labour market. Fiscal policy is helping to cushion the impact of the war in Ukraine for those bearing the brunt of higher energy prices. Temporary and targeted measures should be tailored so as to limit the risk of fueling inflationary pressures. Fiscal policies in all countries should aim at preserving debt sustainability as well as raising the growth potential in a sustainable manner to enhance the recovery. Inflation increased to 8.6% in June.
So, like, there's only like 600, 700 contracts at most prices, but then there are a few prices where there are some really big orders. 2,000 up at 29 in particular.
Stay high in the near term.
That's all really, really
Food
interesting.
inflation also rose further, standing at 8.9% in June, in part reflecting the importance of Ukraine and Russia as producers of agricultural goods. Persistent supply bottlenecks for industrial goods and recovering demand, especially in the services sector, are also contributing to the current high rate of inflation. Price pressures are spreading across more and more sectors, in part owing to the indirect impact of high energy costs across the whole economy. Accordingly, most measures of underlying inflation have risen further. We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain. Higher inflation pressures are also stemming from the depreciation of the euro exchange rate. But looking further ahead, in the absence of new disruptions, energy costs should stabilize and supply bottlenecks should ease, which together with the ongoing policy normalization should support the return of inflation to our target. The labour market remains strong. Unemployment fell to a historical low of 6.6% in May. Job vacancies across many sectors show that there is a robust demand for labour. Wage growth, also according to forward-looking indicators, has continued to increase gradually over the last few months, but still remains contained overall. Over time, the strengthening of the economy and some catch-up effects should support faster growth in wages. Most measures of longer-term inflation expectations currently stand at around 2%, although recent above-target revisions to some indicators warrant continued monitoring. Risk assessment. A prolongation of the war in Ukraine remains a source of significant downside risk to growth, especially if energy supplies from Russia were to be disrupted to such an extent that it led to rationing for firms and households. The war may also further dampen confidence and aggravate supply-side constraints, while energy and food costs could remain persistently higher than expected. A faster deceleration in global growth would also pose a risk to the euro area outlook. The risks to the inflation outlook continue.
Well, it looks like there was some significant absorption down at the bottom, but nothing like super insane. So
the risks to
this is
the
all very
medium-term
interesting.
inflation outlook include a durable worsening of the production capacity of our economy, persistently high energy and food prices, inflation expectations rising above our target, and higher than anticipated wage rises. However, if demand were to weaken over the medium term, it would lower pressures on prices. So turning to financial and monetary conditions now. Market interest rates have been volatile as a result of the pronounced economic and geopolitical uncertainty. Bank funding costs have risen in recent months, which has increasingly fed into higher bank lending rates, in particular for households. While the volume of bank lending to households remains strong, it is expected to decline in view of lower demand. Lending to firms has also been robust as high production costs, inventory building, and lower reliance on market funding have created a continued need for credit from banks. At the same time, demand for loans to finance investment has declined. Money growth has continued to moderate owing to lower liquidity savings and lower Eurosystem asset purchases. Our most recent bank lending survey reports that credit standards tightened for all loan categories in the second quarter of the year, as banks are becoming more concerned about the risks faced by their customers in the current uncertain environment. Banks expect to continue tightening their credit standards in the third quarter. So, summing up, inflation continues to be undesirably high and is expected to remain above our target for some time. The latest data indicates a slowdown in growth, clouding the outlook for the second half of 2022 and beyond. At the same time, this slowdown is being cushioned by a number of supportive factors. The Governing Council has today decided to raise the key ECB interest rates and approved the transmission protection instrument. At our upcoming meetings, further normalization of interest rates will be appropriate. Our future policy rate path will continue to be data dependent and will help us deliver on our 2% inflation target over the medium term. We now stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes at our 2% target over the medium term. Our new transmission protection instrument will safeguard the smooth transmission of our monetary policy stance throughout the euro area as we keep adjusting the stance to address high inflation. We're now ready to take your questions.
Thank you, President Lagarde. And the first question today goes to Annette Weisbach of CNBC.
Thank you very much. Good afternoon, President Lagarde.
Good afternoon.
My first question is on your forward guidance and what the front-loading means for September, because you previously has been guiding us and the market that September will see a 50 basis point hike unless there is a clear signs of inflation going down. Second question is on Italy. We are seeing yields rising with the political uncertainty at center stage. What's your message to the markets? Is the TPI big enough and bold enough to prevent a potential escalation of the situation? Thank you.
Well, thank you very much. And actually, your question helps me give you a bit of an insight of what happened during this really important Governing Council meeting. Governing Council members around the table made two important decisions. The first one had to do with interest rate hikes by 50 basis points, and I will come back to forward guidance in a minute, and also decided to approve at unanimity of the Governing Council, the transmission protection instrument. So let me come back to the interest rate hikes that we decided, and I will come back as a result to your forward guidance question. We debated internally within the Governing Council about the pros and cons of sticking to the signalled 25 basis point of July, which entailed the other forward guidance that we gave in respect of September, and the two of them were clearly a package. And having weighed the pros and cons, we decided on balance that it was appropriate to take a larger step towards exiting from negative interest rates. Okay? And we did that on the basis of several indicators, several elements, which we believe constituted a change relative to our June Amsterdam meeting. And I can come back to those four elements because I think they're important. They all relate to, materialization of inflation risks that we had flagged in Amsterdam, but which we have seen materializing in the meantime. And I think the second important component that played a role in our decision was that the situation has changed in relation to transmission. We had not implemented yet the flexible reinvestment under PEP, and certainly we did not have at the time a transmission protection instrument. So these two elements combined, realization of upside risks to inflation, plus the presence and the operationality of the flexible reinvestment under PEP, and more importantly, the unanimous support of the Governing Council for the transmission protection instrument led us to decide a larger than what had been signalled rate hikes on the occasion of this meeting. That is,
and it looks so.
If you want to go sort of behind,
and I'm looking here at the treasuries. They are of course coming back and are pretty close to unchanged now from before the ECB meeting. But I'm noticing a pretty significant change in the yield curve and significant steepening here.
Of 50 basis points. So it's a strong indication on both accounts in relation to the higher step that we are taking to exit from negative interest rates, and on the other front, which is making sure that our monetary policy stance is transmitted smoothly throughout the entire euro area. Now, the TPI is obviously an instrument that will help us deliver on our mandate of price stability, bringing inflation in the medium term back to 2%. And under that TPI, all members of the euro area can be eligible, all of them. You will find in the press release later after this press conference the detail of the eligibility conditions. But all members of the euro areas are eligible. The Governing Council, in its discretion, in its assessment, will determine, on the basis of the eligibility criteria, on the basis of the indicators that will signal or not unwarranted, disorderly market dynamics, whether or not a country is eligible and whether it activates the TPI. Voila. Thank you.
Thank you, President Lagarde. And the next question goes to Alexander Weber of Bloomberg. Alexander, please.
Yeah, thanks. Alexander Weber with Bloomberg. I wanted to follow up. Good afternoon, President Lagarde. I want to follow up on Italy. Given that right now there's a very clear reason behind market reaction, do you see any way for you to buy Italian debt in the foreseeable future while arguing that market reaction was unwarranted, which would be the condition for the TPI? And then coming back to the September decision, is this really now the interest rate decision for September? Is it really completely open now, or do you still envision a move of larger than 25 basis points?
On your first question, as I have just described TPI, and I'm happy to come back to that in terms of eligibility conditions and decision-making of the Governing Council, TPI is
surprise domino effect. Well, did any of you have gold moves up after ECB rate hike on your bingo card today? Because
countries are in principle eligible to the TPI. Subject to what? Subject to being considered by the Governing Council as eligible to the TPI on the basis, notably, not exclusively, it will be the discretion of the Governing Council to make the decision, notably on the basis of criteria that are very specifically spelled out. If and when the TPI needs to be activated, obviously the Governing Council is going to conduct a thorough assessment of the situation in the affected countries, and the decision to begin TPI purchases, as I said, will be in the entire discretion of the Governing Council. Now, clearly, to assess whether you have unwarranted, disorderly market dynamics, the Governing Council will take into account multiple indicators to determine the warranted versus unwarranted and to determine the orderly versus disorderly. And multiple indicators have been discussed and will be taken into account by the Governing Council. You wanted to come back to September. That's a good point. I think I had addressed that issue with your colleague sitting next to you. I think what I tried to explain in my first answer is that in June we have signaled. It's not exactly what I said, by the way, neither in my blog nor in my Simtra speech, just in case any of you is interested. And very scrupulous.
wait, she has a blog? I didn't know she has a blog.
But at our Amsterdam June meeting, we signaled our intention to increase by 25 basis points. And that was a signal, a degree of forward guidance to that signal that was coupled.
The way she said that was kind of like how I would do it. Well, if you had read my blog
today, which is to increase, and remember, Amsterdam, for those of you who have forgotten, was we intend to increase by 25 basis points, and at our September meeting, the incremental increase will be possibly larger than 25. And some of you have assumed that it might be 50. But we decided to go for 50 basis points hike in June, and therefore the combined forward guidance that existed for September is no longer applicable. I think if you go back to the monetary policy statement, you see very clearly that from now on, we will make our monetary policy decisions on a data-dependent basis, we'll operate month by month and step by step. So what happens in September is going to depend on what data we have for September. But we are definitely on a normalization path, in order to reach our medium-term objective of 2%. So let me repeat again, because you seem to frown. We will determine in September the basis of the data that we receive. And this is a projection exercise in September, remember? That will include all the national central bank in the exercise. So on the basis of the data that we receive at the time of those projections, we will determine what step we take on the normalization path that we are taking in order to deliver on our medium-term 2%. Now, that doesn't mean to say that we are changing the ultimate point of arrival, okay? We are accelerating the exit, and we are following the path of normalization that we have flagged. Thank you.
Thank you.
Be happy, journalists. More interest rate uncertainty and less forward guidance is good for you. Don't be mad about it.
Thank you for having my question.
Isn't it funny how all of the central banks all at once all kind of had to end the whole forward guidance thing?
The retail
Like, forward guidance is really great when everything is going the way that it's supposed to, but then when a crisis hits, it's like, oops, that's not going to work.
Just a normal private person that is in the market and now wondering what this will do with his or her money.
Well, first, we are moving all three interest rates by 50 basis points. So
I need to learn more about the European Central Bank system because I didn't know that they have 3 interest rates.
For those who borrow from banks is assuming good.
They're moving higher here again, guys.
Given that we have a transmission protection.
Back to 118, which is kind of where we've been at quite a lot over the past 2 weeks.
That's pretty obvious. And why is that actually beneficial at the end of the day for those in the retail sector, for those consumers, for all economic agents? Is that the most precious good that we can deliver and that we have to deliver is price stability. So we have to bring inflation down to 2% in the medium term. That is the imperative under the treaty. That is the strategy review objective that we have set for ourselves, and it's time to deliver.
Thank you. And the next question will turn to WebEx and goes to Francesco Canepa of Reuters. Francesco, please.
Yeah, good afternoon. So my first question is whether you are going to announce TPI purchases when you make them, and whether you are going to sterilize them, and if so, how?
And if so, what?
If so, how?
Huh?
How?
Oh, how? Okay. Thank you very much for your question. As far as publication is concerned,
say what you want. The ECB has more fun in their press conference.
According to publishing principles and rules that we apply. Okay, so that's answer to your question 1. And as far as the other question is concerned, I would just like to clarify that if TPI is activated,
okay. Whoa.
it will avoid interference with the appropriate monetary policy stance, and we will address the implications of TPI purchases for the scale of the aggregate Eurosystem monetary policy debt security portfolio and the amount of excess liquidity. I'm not going to go through the details of exactly using which mechanism, sterilization or otherwise, that we would be using. These are practical matters that certainly have been discussed, have been agreed, but if you
seeing this?
The transmission protection instrument is intended to facilitate, enhance
what the heck?
Transmission.
They just jumped 16 ticks. Holy shit.
That we will and the ECB will be capable of doing that. And the ECB is capable of going big for that.
Apparently, TPI is a big deal.
And this one goes to Tonia Mastrobuoni of La Repubblica. Tonia, please. Tonia, we can't hear anything. Can you hear us, and can you unmute, perhaps? Doesn't seem to work. I will come back to you.
Almost spit out my coffee, says Jacob, dude. That was a fun move. I haven't seen one like that.
Thank you very much, Madame Lagarde.
During a press conference in a long time.
2020, you said that you were not
totally screwed up my 5-year, right?
Does this transmission protection instrument mean that you are now here to close the spreads? And will it be used to counter the increase in borrowing costs that we've seen in Italy as a result of the political uncertainty that's developed there? Thank you.
I think I dropped a frame or two.
You give me another opportunity to clarify exactly what TPI is about. TPI is going to be an addition to our toolkit. And it can be activated to counter unwarranted, disorderly market dynamics that pose a
okay, so TPI is their new anti-fragmentation instrument
across the euro area. And why do we do that? Because we want to make sure that we deliver on our mandate. We want to make sure that our monetary policy stance is transmitted throughout the entire euro area. It's not the only tool that we have in our toolkit. We have two existing tools already. We have, number one, PEP, and in particular the flexible reinvestment of redemptions, as we announced back in June, which is now operational. So the flexible reinvestment of...
So I think that where that was significant, so this is their new bond buying program to help with periphery states to keep the periphery and the core closer in line with each other. And she basically said the ECB is capable of going big on TPI, meaning that they could end up buying a lot of bonds to do that. I don't think that that really affects treasury yields in the United States per se, but I think that that's why they were buying off of that.
Now we have TPI that I have just described in order to...
TPI is the Toilet Paper Pricing Institute.
So we have the three instruments in the toolbox, and they all can be operated. As I have said, and I will repeat, TPI...
Did you just come up with that yourself, Octavius? Because I think you might have just coined a significant financial term here.
...of the euro area, because our concern is that monetary policy is transmitted throughout the entire area. So when the Governing Council will determine that...
That's what everybody's going to call it now.
...eligible under the 4 criteria that I'm happy to come back to, and on the basis of the indicators that there is disorderly market dynamics, then it will decide that that country is eligible to TPI. It will activate. And as I said earlier on, there is no ex-ante limit.
There is no ex-ante limit.
Now, I'm happy to go to the 4 specific criterias.
Jeez.
Maybe I will. Yeah. So there are 4 of them, and I think it's important that we understand that on this occasion, like on any occasion having to do with either monetary stance or monetary policy transmission, the ECB determines in its own discretion, not being hostage to anyone. So the 4 criteria that it will use will be indicative, will be elements of information that it will take into account in order to make its decision. So the first one is compliance with EU fiscal framework. And that can take one of 2 forms, either not be in excessive deficit procedure or having failed to take the effective action in response to Council recommendations. So that's on the fiscal framework. And obviously it borrows from the other European institution, which is both the Commission and the Council. The second is the absence of severe macroeconomic imbalances. And again, it's from other European institutions in relation to the excessive imbalance procedure. The third is fiscal sustainability. So this is making sure that the trajectory of public debt is sustainable.
Why am I getting buffering?
To do that, the Governing Council will take
into account
analysis by the European Commission, by the ESM, by the IMF, by other institutions, but it will certainly be together with the ECB internal analysis. And fourth, sound and sustainable macroeconomic policies complying with the commitments recovery and resilience plans for the RRF and the European Commission specific recommendations in the fiscal sphere under the European semester. So you have a combination of criteria ranging from fiscal to macroeconomic to compliance with the RRPs in particular, and obviously the DSA. So all these 4 categories will be taken into account by the Governing Council, but once again, the Governing Council decides in sovereignty in respect to eligibility to the TPI. Thank you.
Thank you, Madame Lagarde. And the next question goes to Aude Kersulet.
Does the ECB have an impact on the U.S. economy? Well,
thank you.
I mean, it's kind of limited, but then everything kind of affects everything, especially when we're talking about short-term trading here, right?
Credible. And you just spoke about downside risk, and some institutional studies show that this will lead to recession and raise energy costs again. That happens, will this be a signal to reverse monetary policy and become accommodative again? What could be the reaction of the ECB?
Well, thank you very much for your question. But as you know, the primary mandate of the ECB is price stability, which we have defined as the 2% inflation medium term. And what we observe is on the outlook front and on the inflation front, and we try to assess what are the risks to both. We see downside risk to growth. I've explained that in detail in the monetary policy statement and made specific reference to the unjustifiable, unacceptable invasion of Russia against Ukraine and consequences as a result of it. And we are seeing upside risk to inflation.
Forex live tweets. Anyone have a problem with the ECB taking the reins of Eurozone government policy making?
So, as ECB, what we have to do is act in relation to inflation given the circumstances. That's what we're doing. To your question about the impact of gas, it is clear that energy prices play a critical role in the high inflation numbers that we are seeing, that are undesirable and that we will unfortunately continue to see for some time. So we are very attentive to what happens on the energy front, and in particular on the gas front, because it has an impact on electricity price, as we all know. So most recent evolution concerning the gas supply, through Nord Stream 1 in particular, is obviously a factor that we take into account. And the decisions that have been announced by the European Commission in relation to savings, in relation to solidarity, in relation to inventory, are also taken into account in relation to the role that energy plays in relation to inflation, but also obviously in relation to growth. So we are very attentive to all these factors. Is that going to lead to a recession? You know, we look at our projection dating back to June. We look at the most recent forecast published by the Commission last week. Under the baseline scenario, there is no recession, neither this year nor next year. Is the horizon clouded? Of course it is. Thank you.
Thank you, President. And we'll try it again with Tonia Mastrobuoni of La Repubblica. Tonia, please.
Yes, hello. Hello, Madame Lagarde, and sorry, I couldn't cope with my technical problems.
Sure.
Good afternoon. I have two questions. The first, I would like to go back to Italy, of course, because it's not only a question of debt. I mean, how worried are you about the collapse of the Draghi government, also due to the fact that Italy will become a large part of the next generation EU, which should fuel also the growth in the Eurozone, and that this is a reform path, and so also the next generation EU money it receives could be interrupted by this political crisis, so also threatening the growth outlook in the whole Eurozone. And my second question, I mean, very often in the last decade at least, unwarranted the rises of rates on government bonds were caused by political crisis. So if I'm not wrong, you mentioned the 4 criteria, and Italy would meet these criteria at this moment. But this is, of course, a crisis which is caused by a political reason, by a political cause, a government crisis, self-inflicted by Italy. Would you think that this could be considered as an unwarranted rise of interest rates on the government bonds if it went on? The spread is already rising this morning. Thank you.
Well, thank you so much for your question. Let me just remind you that the ECB does not take a stance on political matters. Political matters are the democratic process of each and every member state. And that is certainly the case for the country that you're referring to. Differences in local financing can legitimately arise, among others, due to the country's specific macroeconomic landscape. That has happened in the past. So the Governing Council will make the assessment of whether a country meets the eligibility criteria or not at the time when it has to make those determinations. And it will do so having a sort of threefold assessment, if you will.
That won't ever be abused ever. We get to decide whether you get the money or not.
Transmission indicators. There's a whole range.
It's not political, though.
Of such indicators. Second, it will at that time evaluate the eligibility criteria. And third, and that's very important, it will have to make a judgment call that activation of purchases under the TPI is proportionate to the achievement of the ECB primary objective. Now, those of you who are familiar with the legal requirements and with the concept of proportionality will have understood what I mean by that, but this is obviously operational in relation to any activation decision that is being made.
Thank you, President. And now the next question goes to Pablo Rodriguez of El Mundo. Pablo, please.
Yeah, thank you very much, Madam. I have a couple of questions, if I may. The first one is that 14 years ago, one of your predecessors here, when there was a rise in the rates, he dismisses the argument that
14 years ago?
Sorry? 14.
Oh, okay.
14 years ago.
14?
14.
Okay.
He said he dismisses the argument that the rise will put further strain in the peripheral countries. And he said, I don't buy that argument. I was wondering if now you kind of buy that argument, because in a sense, this new instrument you are announcing, even though it's just an extra one, basically those criteria describe pretty well those countries in problems that 14 years ago may need the help of the ECB. So do you think that the economies are more resilient right now, or just an instrument as it is, it will help them to compensate the effects of the new rate? And the second one, if I may, is the Spanish government has announced a new tax on banks for windfall profits. I was wondering, because they explain they do that because of the interest rates rise. And I was wondering if you have an assessment, you will eventually have an assessment, and you have an opinion as you have in the past, because it has happened before in other countries, and I was wondering if you think it's actually a good answer for after what it has been announced, or just because of what has been announced today here. Thank you.
Thank you so much for your question. I think your second question will be addressed by my colleague, the Vice President de Guindos.
Well, good afternoon, everyone. Well, it's very difficult to give an opinion when you do not know, the concrete details of the tax. We do not know the characteristics. We do not know whether it will be a tax on profits. It will be a tax on assets. So it's, that's the first thing that we have to say. We do not know the details, and so our opinion cannot be complete in that respect. What I can tell you is what has been our policy line in the past with respect to taxation of banks. No? And if you look at our opinions in the past, they are quite clear. What they tried to make quite explicit is that the tax should not impair credit extension, credit growth, because this is important for economic activity. Second, that we should try to avoid any sort of tightening of financing conditions for households and corporates. And finally, that the tax should not damage the solvency of the banking industry. This has been always, in the opinions that we have produced in the past, it has been always, this kind of message to the governments. But I repeat again, we do not know the concrete characteristics and features of the Spanish tax that has been announced, as you have said, by the Spanish government, and so in order to have a much more concrete and specific answer and response and opinion, we will have to wait a little bit.
Yeah, and to your first point, that helps me to yet again come back to TPI, because in the monetary union, there is an inherent risk, particularly the monetary union that we have here in the euro area. There's an inherent risk that a large shock can create fragmentation risks. And that can lead to self-fulfilling market dynamics that are not warranted.
There's a lot of commentary on Twitter about that whole interaction between Lagarde and the journalist saying, I can go through the criteria if you want.
Can have different sources. And that is the reason why we have several tools. As I said earlier on, we have the flexible reinvestment of PEP, which has been deployed, is currently operational. We have OMT, which was decided back then for another unwarranted disorderly market dynamics, but having to do with more country-specific matters, and closely associated with the redenomination risk, because that's really what it was designed for at the time, if you remember. So we were short of this particular tool, which is the one that we have in front of us, the transmission protection instrument, that is not related to redenomination risks, but to the unwarranted disorderly market dynamics that can impair the proper transmission of monetary policy throughout the euro area, which is, as I said again, it's with no limitation ex ante, which has been designed carefully with adequate attention paid to the safeguards that are necessary for that instrument to be valid, and with a creditor seniority that is pari passu with any other creditor, in order for it to be efficient and not to crowd out. So that's what we have done, and I can assure you that we would rather not use TPI. The Governing Council would rather not use it, but if we have to use it, we will not hesitate. We will not hesitate. Thank you.
Thank you.
You see what's going on here? There's like the whole market is basically like, this is bullshit. And she's like, fight me. You know you'll lose that, right?
You're right.
Oh, yeah.
All right. Okay, I've got two brief questions. Your previous forward guidance to this rate decision is about 5 weeks old. Yet the rate hike decision is a lot bigger than anticipated. Did the monetary conditions in the Eurozone deteriorate that fast, or is the agreement on TPI giving you the ability to go further than you anticipated? Second question, you stated that you're on the path towards normalization. What interest levels are considered normal by the ECB? Thank you.
Thank you very much. The reason we decided by total consensus around the table to depart from the signal that we had given back in Amsterdam was twofold. Number one, we had clear realization of upside risk to inflation, and I can give you a list of those examples. Inflation going from 8.1% in May to 8.6% in June, way above our forecast. Seasonally adjusted month-on-month inflation rates that show strong inflation momentum for nearly all components. Number three, a broad range of indicators of underlying inflation that have continued to increase, and pipeline pressures that are rising to record high levels. And added to that, which relates essentially to inflation, the euro-dollar rate that has fallen substantially in the last few weeks, which obviously has a bearing on inflation going forward. So it's on the basis of that set of monetary policy stance-related elements that we have taken the decision. As I said, twofold, inflation-related, and second, the fact that the concern that we had about monetary policy transmission is addressed by, number one, the deployment of the TPI, the PEP flexible reinvestment policy, and second, the unanimous support of the entire Governing Council to a strong and powerful transmission protection instrument that I have just described earlier on. So on the stance front, we had good reasons to revisit, and on the transmission, we are confident that the existence of that mechanism, its ability to be deployed, is actually reinforcing our capacity to deliver on our price stability mandate and to walk that journey of monetary policy normalization. Now, as I said earlier on, going from the signal 25 to the 50 that you are seeing now is a higher step out of negative interest rates. So we're now moving in one go to zero. Does that mean that we are changing the terminal rate at which we want to arrive? No. Does that mean that we are going to move extremely fast? As I said, we will be operating month by month, meeting by meeting, on the basis of data, and we will adjust and calibrate accordingly. We are much more flexible in that we are not offering forward guidance of any kind. I was asked several times the questions about September. There is no such thing. We are data dependent. But the ultimate destination of our policy path remains the same, which is to progressively raise interest rates to broadly neutral setting. That's where we want to arrive at. Okay? And if you're asking me next, what is the neutral setting? At this point in time, I don't know. What I can observe is that it has changed over the course of the last few years for a reason of factors having to do with demographics, with productivity and all the rest of it. And as seen by markets, it has also significantly adjusted in the last few weeks. So we will cross that bridge when we cross that bridge. Thank you.
Thank you. And the next question goes to Christian.
She should not have said that like that way. This is just not a confidence-inspiring way to speak. It's okay. Not a huge deal.
That the time with the negative interest rates is over now.
I tell you something. I think it's a rather historical moment, for me at least, for two reasons. One is it's very good when a whole team, the whole Governing Council, 25 members around the table, actually are in complete alignment and support for a transmission protection instrument which we regard as critical in order to properly transmit our monetary policy going forward. So in that respect, at least from the president of the ECB point of view, yes, I think it's quite a gratifying moment. It means that staff has done an enormous amount of work, that all members of the committees that are bringing together the expert of the national central banks, Bundesbank included, of course, have worked really hard, and that we have come to the same view without any reservation. So it is important in that respect. I think, it's the first time in over a decade that we raise interest rates. And moving out of negative interest rates, by all accounts, certainly to me, is going to facilitate a number of things that we can explain to European citizens in order to help them understand what we are trying to do in order to reduce inflation and in order to procure price respects. Yes, but I have a short history as a central banker.
The last question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you. Good afternoon, and thank you very much.
What the heck?
If I may go back to TPI,
Was that a prediction or an egg?
the market calls it a shield.
What did she just say there?
A shield that can protect all countries, but it's also complex. And by the way you described it, how fast can you trigger if a country needs this kind of shield? And once you trigger it, it means that the country is protected for.
Well, what would you do if you were in this situation, right?
Teltros, because
like everybody knows what they're doing.
Modify Teltros.
How can you be confident about it? You know.
Operations.
Well, it's not even like it's confidence. It's like they know that they'll probably get away with it, but they also know that nobody's going to like it.
Very much. The transmission protection instrument is an instrument. Okay, it's one that is intended for transmission of monetary policy throughout the euro area. So we intend to use it as a tool to make sure that monetary policy is transmitted throughout the region, our region, and is smoothly transmitted without being impaired by unwarranted, disorderly market dynamics. It is not so complicated. You will see, because the press release will...
It's not so complicated.
And it will not give you, by the way, all details. Okay?
By the way, they're going on longer than they usually do, right? S&P 500 is opened up.
Some key terms and conditions.
Usually they have this done before the S&P 500.
To be there, because there is an element of discretion and judgment on the part of the governing council members to decide or not activation and to assess eligibility or not. And there are certain components that are best kept unpublished, undisclosed, and commented upon. And I'm sure that you understand.
I'm sure that you understand.
Developed in record time by our teams. They can work fast, we work fast, and we can do so at any point in time. In relation to eligibility, in relation to activity, in relation to drafting, which has been the case. On Teltro, as you will have noted in the monetary policy statement, there is particular...
We're getting lots of content for our Christine Lagarde's greatest hits video, right?
For remunerating excess liquidity holdings. You know, what has worked in one direction has to be identified, analyzed, and properly addressed in the other direction. We are now in the process of normalizing. Other principles apply, and that's what we will do in the near future. Thank you so much.
Thank you very much. That brings our press conference to an end. Thanks a lot.
Okay. Man, I have never seen anything like that ever. Like this I guess the closest comparison I can get to is like was it 2018, 2019? Right? So remember there's this whole thing about the market was not doing very well, and the Federal Reserve still came in and did an interest rate increase in December, and then the market just threw like a whole fit for the whole month, and then eventually the Federal Reserve acquiesced, and then we had a huge rally going into January, February, March of that year. You remember that whole thing? It's kind of like that. They came out with this policy. Okay, so bonds, one of the things that affects the pricing of bonds. I'm making this video. It's like how do you trade interest rates, right? Here are the major factors involved. Okay. One of the major factors is the risk of default, right? How likely is it that they are not actually going to pay you and you get screwed? And the pricing has to reflect that risk, right? And that's why companies, for instance, have higher rates than countries and so on and so forth, right? So right now, the market is saying the chance of Italy defaulting is a lot higher than the chance of Germany defaulting. And the ECB says, well, that's a problem because we want interest rates to be, at this place for sound monetary policy across the Eurozone. So what are they going to do about it? They've created a new program to go in and buy the Italian bonds. If I was one of the big portfolio managers, man, So the thing is if the ECB is going to buy them, then you want to buy them and sell them back to them, right? But part of me just makes me feel like, so just don't play. Oh, ECB, you want to go and buy them? Okay, you can buy all of them because I ain't going to do it, right? And you notice she's warning because she knows the real risk to this, right? Well, first of all, ECB buys all these bonds, and then Italy actually defaults and they become worthless, right? So what happens in that situation, right? Can the central bank actually keep itself propped up? I mean, you print more currency, but then that could like decimate the currency, right? But what happens if there's actually a default? But what she's more concerned about here is that the market decides to fight her. She's worried that George Soros comes in and says, okay, we're going to sell all the Italian bonds, right? And then the ECB is required to fight it. And they're like, well, we'll win that battle, but they would certainly rather not have it, right? So, of course, she's kind of appears unconfident. I mean, people have been, ever since she got in, attacking her, saying that she's not qualified to be ECB president and that she shouldn't be in there, right? But you can see what's going on here, right? Like, they don't really have a choice. In order to keep the Eurozone together, they basically have to deal with this periphery issue. And the ECB is the only one that can do it, right? So it's not like they want to do it. It's not like they're sitting there going like, oh, this is a great idea and everything. It's like for their own survival, they basically have no choice. And what was going on there in the press conference was all of the journalists basically being like, really? This is really what we're going to do? Like, this is okay. Because again, the whole point here is for the market to price in the risk of default. And if Italy is going to default and the ECB comes in and says, oh, it doesn't matter, we're going to buy them anyways, like, you've just it's such a distortion of the market. I mean, obviously, central banks have been distorting the markets for a long time here now, but this is really starting to like get out of control, don't you think? I'm looking at the comments that you guys are posting in the middle of this, and normally I'm the guy that's kind of like, well, you don't want to fight the Fed, and kind of giving some background information about why the central bank policies are usually very prudent and that these people are very smart and know what they're doing. But I'm totally with you on this one. It's like I'm not going to be the one to go and fight the ECB, but I ain't going to go and buy Italian bonds. I tell you that. I'm not going to go and buy Italian bonds. ECB, you can go buy them. I don't want them. I don't want them. Not that I have, enough money to really buy bonds like that anyways, but if I did, wouldn't buy them. If I had some, I'd be getting rid of them. I'd be, okay, cool. ECB, you buy them. I'd sell them to you. Let me out. Because if I had the Italian bonds, I would be losing right now, right? I'd probably be underwater, right? Okay, get me back to break even. Let me out. Sure. So I've really just the way that the press was kind of fighting her on it, and the way that she kind of responded, I haven't seen anything like that. It was really, man, something else. What do you think is going to happen? I'm going to be really interested to see all of the commentary and stuff today. I wonder, sometimes it's really hard to keep up with the ECB, right? Because they have all of these different programs and the whole thing the whole thing of just having one monetary policy for completely different countries with different fiscal policies and everything just seems a little crazy to me. It seems a little crazy to me, and it's just so hard to keep up with it. But maybe this is the thing that really puts this all on the news, and we get some time to learn a little bit more about it, maybe. Yeah? NASDAQ killer, you're late. You missed all of the fun. Had all sorts of crazy things happened. Well, where do you think the bonds go from here? Tax it. Now that would be something else too. The ECB is basically going to come in and buy the Italian bonds. They've created the what was it that we called that? The TPI? Was that what it was? Yep, TPI. Octavius says it's the Toilet Paper Pricing Institute. We did fix our micro 10-year treasury futures. But, oh, you know what, by the way, you come in here and look at further out. Do people actually put limit orders further out? 10s? Okay. Okay, sure. I'm just going to leave the 5-year broken like that because it's fun. We did fix the 10-year. We got to fix the other 3 now. I only told them, oh, the 10-year is broken. I didn't list all of the ones that were broken. I don't think it was Jigsaw. I think that Rhythmic might have the instrument data wrong or something. But basically, some database somewhere has the tick size incorrect. And so they updated it to the correct value for the 10-year and then had me like reset everything. So now they need to do that for the other instruments. Okay. Brannigan Barrett, summary of the ECB. New instrument, whilst good intentions, may not be deployed as aggressively / intentionally as market thinks Italy will need. Okay, will not be deployed as aggressively / intentionally as the market thinks Italy will need. ECB played down the 50 basis point hike by saying just because they hike 50 today doesn't make a future path of hikes more aggressive. Effectively, they want to get to a neutral rate quicker, not more aggressive hike path. Overall, very bad outcome for the euro. Given Italy's risks and gas risks, the euro should be back at parity pretty fast, says Brannigan Barrett. I'm inclined to agree with him. You got 2 cents there in the euro, though. It's not really. It's been strengthened here. Although it's been, I mean, look at the dollar, right? At first, the dollar was getting killed, and then it roared back. And you're kind of seeing this stuff across the board. Like all of the interest rates ended up moving higher in the end. They did a knee-jerk lower off the news, which I think is appropriate given a 50 basis point hike, and then they roared higher. You took a trade in the 2-year? You're crazy. This whole day here was a little crazy. I think that trading an event like this is particularly difficult, and if you made money, I would really seriously look at yourself and consider that you may just be really lucky, because You get all sorts of really crazy things happen off of this. The liquidity is light anyways, so that kind of makes it really hard to execute too. But I'd say somewhat bizarre moves. Crazy market. But I think, first of all, there was some positioning going into this because a lot of this was leaked. But then the other thing that's going on is that it doesn't sound like the ECB wants to go hawkish or tighten rates or anything. It sounds like they're just saying, oh, well, I guess we have to go to neutral. But, they're going to neutral and then kind of saying, well, yeah, but we might bring it back down later. Like that's kind of what the market is saying, is that it won't be high for very long. So we'll see what happens. But it's a bit of a funny move. But oh man, the amount of political fodder that this gives people, zero hedge is gonna have a field day with this, right? I've been refreshing their page waiting for they had their like synopsis of all of this, but here you go. Euros tumble. I'll just read this. This is from Zero Hedge. I'll read this article. Euro tumbles and spreads blow out as market realizes the ECB's TPI is just another useless word salad. Initially, both European bonds and the Euro USD moved higher after the ECB unveiled a higher than expected 50 basis point hike. Although the same is leaked, so the ECB effectively destroyed any remaining credibility its forward guidance may have had. However, barely had the Euro USD hit session highs when the Dow started to spread, starting with Lagarde's confirmation during the ECB presser that the central bank's prior guidance for a September rate move no longer applies, and as we showed earlier, the market immediately started pricing in a much lower rate hike in 2 months, as it priced in a much more rapid onset of the recession, thanks to the ECB tightening conditions more than expected just as the economy contracts. It only went downhill from there, quite literally in the case of the euro, with the common currency tumbling from session highs to session lows, taking out the pre-ECB level to the downside. While the infamous IO spread between the Italian and German yields blew out to session highs. For one simple reason, the market realized that the ECB's newly unveiled Transmission Protection Instrument, or TPI, because the Italy-specific QE sounds a little gauche. Gauche, is that how you say that? Is just another OMT-like word salad, which is meant to scare markets and never actually be implemented practically. Here's why. First, as Lagarde explained, the ECB alone will decide where to deploy this crisis tool, and that all Euro area members are eligible for the TPI. Here's what she said. Obviously, the Governing Council is going to conduct a thorough assessment of the situation in the affected countries, and the decision to begin TPI purchases, as I said, will be in the entire discretion of the Governing Council. She added that the TPI is a program that is designed to address specific risk that all Euro area countries can face, and now clearly to assess whether you have unwarranted disorderly market dynamics. The Governing Council will take into account multiple indications to determine the warranted versus unwarranted. While it is great that every European country is viewed as a potential crisis by the ECB, what is troubling is that the decision on access will be made by the Governing Council. There is still no detail on how that decision will be made, but it seems then ECB is taking a lot of discretion on how and where it can help close bond spreads. Even Bloomberg writes that for the central bank, this seems like a very dangerous path to be on. If the GC disagrees on a country, the Governing Council, if the Governing Council disagrees on a country's fiscal stance or on some other politically controlled factor, then it is risking becoming a very politicized organization. For a vivid example of this, just ask Silvio Berlusconi, who lost his job in 2011 after the ECB decided not to buy Italian bonds, sending their yields through the roof. Okay? So you understand that? That was kind of the critical point that they were arguing here. She's like, well, we're not into politics, and the media was calling BS on it because they're basically saying at some point a country's fiscal situation becomes a point where, it's just a guarantee that they're going to default. Are you really going to come in and buy the bonds then at that point? No, you're not. So which situation do you buy it and which situation do you not buy it? And it's completely in your discretion. That then ends up becoming, yes, a political decision, because you're going to have an impact on the politics and who is president there or not, based on whether you decide to buy their bonds or not. Second, and more important, however, is Lagarde's disclosure of the 4 specific eligibility criteria for TPI, as she claims that the ECB determines in its own discretion, not hostage to anyone. The conditions are the following: compliance with EU fiscal framework borrowing from the European Commission, absence of severe macroeconomic imbalances, again borrowing from the Commission, fiscal sustainability taking into account European Commission analysis and others such as the International Monetary Fund, sound policies that are in line with the country's commitment to recover fund plans. There is a problem with this, since the TPI is meant to rescue Italy. If these conditions are closely adhered to, it will make TPI usage, in the case of Italy, impossibly, or as some sarcastically point out, Italy will surely be in compliance after the elections in September/October. Right? So basically, when you talk about the criteria, so the country has to be in compliance with the EU fiscal rules. There has to be an absence of severe macro imbalances, fiscal/debt sustainability, and sound and sustainable macro policies. Well, is Italy have fiscal and debt sustainability? No. Right? So they created an instrument for Italy, and Italy doesn't meet the criteria. But they're going to do it anyways. Okay. Chances of BTPs not meeting these criteria come September/October pretty high now. Yeah, okay. So basically, after the elections in Italy, whatever party will win will have to follow that criteria, or they're screwed. So it is kind of forcing a certain policy in that country. By the way, new highs there. 2.97 now. Jeez. Bottom line, yes, the ECB was surprised with a bigger than expected rate hike, but realizing that the TPI is just another meaningless, unusable word salad, the market has sent the euro tumbling and the Italian years blowing out so wide that the TPI may have to be used before the end of the day at this rate, or as we put it. If you ask for your miracles euro shorts, I give you the ECB. And we are seeing some weakness in the euro, but nothing too dramatic. They got to 1.02. So will the euro move lower from here? Well, at the moment, the treasuries are pushing up, man. They are pushing up. Well, the S&P 500 did take a little bit of a swing down. The chart is incredibly messy here on a 5-minute chart. So there's a lot of range-bound chopping. But if there was going to be okay, we did the rally, we got to the 50-day moving average, now we need to move back down. If there was an opportunity to try and do that, I think that now would be the one in the ES, right? We could try taking a short for kicks and giggles at some point, couldn't we? Why do you bring up Amazon left? That's not relevant. Great investment. Well, Amazon sure does look good. I hear, where was it? I forget what the name of this podcast is. it's Chamath's podcast with his buddies, right? All in podcast or whatever. He's one of those guys on there was saying that Jeff Bezos is going to run for president. He was just speculating that Jeff Bezos would run for president. I think Jeff Bezos could make a pretty good presidential run. Actually, it made a lot of sense. He's a good public speaker, at least. Who knows how he does on the debate stage, but maybe he does want to be president. I don't know. Wow, AT&T's shares have fallen more than 9% this morning, their biggest slide since 2002. The wireless carrier cut its forecast for free cash flow this year by $2 billion. Jeez. I've been looking, myself and Uzi, we've kind of been eyeing AT&T, and I never got into it. Probably should have, but there's been, I don't know. I put money into other things that were probably worse investments, but you know, I've been thinking AT&T could be a good play in the longer run, but nope, it just continues to suck. And now down 9%, like that is, ugh. That's a real gut check if you own that thing, man. Euro JPY sees a massive 150 pips. Volatile trading on the ECB. Live Squawk retreats. Raoul Paul says there is a huge drop coming in ISM in the next month or two, something I've been warning about. The ISM is in blue, the Philly Fed is in white. Philly Fed is pricing the ISM at 44. That would be bad. 50 is like even in the ISM, right? 44 would be bad. Full recession. Amazon to buy primary healthcare provider for $3.9 billion. Who was it they bought? One Medical. You know, I wonder. Do you think this could be affecting the Medicare exchanges? Let's see here. Well, WTW is up today, but not like a ton. Amazon was up big yesterday, but not so much today. It kind of, you know, this story with Amazon really just makes me think, what other moves are they going to make? Right? But apparently Jeff Bezos thinks that he's going to fix healthcare in America, right? Like, again, it all kind of, Jeff Bezos running for president, that one makes a lot of sense. And he could talk about this and all of the work that they've been doing in the healthcare industry. What's Nassim guy here? The YouTube video, is that an older YouTube video of his that he's linking us to, or is he post something new? No, that was why we don't use Black-Scholes. That was the older one. That was the last video I think he posted, but it was a while ago. Well, they're still moving. Liquidity has returned to the treasuries. Do have so now that I got full market depth, right? We can see all of the fun stuff. Do I really need 64? I don't think I do. I think that I'm gonna change this, the market depth to 32. 32 rises. 32 is more than enough. Because every one that you add on there is potentially more resources, right? And memory. So I say let's just keep it to 32. That's enough. I can see kind of, you know, a ways out, but all three of them kind of seem to have, well, except for the 30-year. 30-year doesn't have them, but these ones, they seem to have something above us. Meanwhile, spreads. Well, spreads did steepen considerably, but it is now starting to mean revert a little bit, and there's the S&P 500 taking the plunge. Can I... We'll bring our thing over here. That might be a short-term reversion. I don't know. Take one off there. All right. Meanwhile, in Great Britain, Theresa May won 60% support from her MPs en route to becoming party leader in 2016, while Boris Johnson had 51% in 2019. By contrast, Rishi Sunak and Liz Truss, the two top frontrunners, enter the runoff with support at 38% and 32%, respectively. So even though the Conservative Party seems to be dominating in European politics, they don't seem to have a very clear leader. And they continue to struggle at finding a leader. Why do you think ES is worth trading right now? Because I'm bored. But actually, I'm just seeing everything looks negative today. And then we just had all of this ECB mess. So now that this ECB mess is out of the way, I think that people can turn their focus towards trying to correctly price these things. And I see the orders for today in the ES being negative. I think that we just had a pretty good break there. I probably should have been going short somewhere around 39.50, but that's okay. Now that they've broken some of these downside levels, I think that there's a really good chance that they're going to start trying to move back into, what was it? The 19th. So like Monday, Tuesday levels. Now the key 38, 39, 38 is kind of like the key level on the downside. So we might see a little bit of chopping around there, but yeah. Oh, geez. Did I never change these over here? Okay. Well. Add some contracts there at 50. I think I'll add 2 more. it's all sim. I'm not very good at trading the E-mini, so maybe the play is you should fade me here. They hit back up. Well, sure. I'll take them. I'll take them at 39.50. That would have been a better place for me to have gotten in. Anyways, so. Okay. Well, I got filled. So I will now take him off here. I mean, it does look like they're kind of in a swing back the other way, so clearly bad place to have tried to open a position anyways, but I don't know. It's the ES. What you gonna do? What you gonna do about it? I don't know if it's a good trade. Now here in the treasuries, I mean, I guess you would have to go long, but I'm not so sure about how much more upside there really is to this. But the whole thing is just kind of a little crazy. I wouldn't count out the possibility of some sort of quick move to like stop people out and stuff. The way they're trading, I was kind of like, yeah, I was too slow there on that one. That one was a clear as she goes potential. It's already passed though. We'll let it come back down now. What's the next news that could shock the market? That's a good question. Well, we do get something tomorrow, don't we? Yep, that's right. Flash services PMI. Yep. So PMI could be, I'm going to guess that the PMIs are going to be bad. But we're still in, it might not do a whole lot until next Wednesday. So I think that we're probably going to be into this space where you see kind of like a gentle trend. Oh man, they come through that so fast right now. Yeah, that's super aggressive order flow for sure. Of course, it didn't get the fill on the other side. Here's ES turning back down. White House says President Biden has tested positive for COVID-19. Biden experiencing very mild symptoms. Repeat. White House says President Biden has tested positive for COVID-19 and is experiencing very mild symptoms. I mean, that's the one that could potentially be a market mover just because a story like that's going to suck a lot of the air out of the room, guys. Doesn't he also have cancer? No, I think you're thinking about Putin. Basically, they're trying to downplay it. But remember, that's exactly what they did with Donald Trump, too. Was like, he caught it, it's no big deal. And then next thing you know, he's in the hospital. And that one did affect the markets, didn't it? The markets kind of took a little bit of a swoon when that happened. I don't know. Let's fill me here at 39.39, and then I can say something else about it. Does Biden has asthma? What? I don't know. I've never heard that before. Are you guys spreading misinformation again? Chat, come on. We should check these things. Biden asthma. Oh, I see what you're talking about. Oh, that's funny that all of the top stories about this are from India. Apparently, Joe Biden said that he had cancer, but then the White House clarified when he said, "I grew up with cancer."
So we are now 5 minutes away to the bottom of the hour.
Biden was referring to a history of non-melanoma skin cancer before assuming power last year.
44 BCF on the prior 58 BCF.
I seriously doubt that he would be able to do another term physically. Well, I've seriously doubted that he'd be able to do this term physically. And I mean, from what I've seen, he hasn't been able to. But that doesn't mean that he's not still the president. Right? Okay, so now that I'm filled, if there is a market move off of this, and I think that there would have to say like Joe Biden's condition is worsening and he's going to the hospital. Okay, so if we get a news headline, Joe Biden is now in the hospital for COVID-19 treatment, I think the market rallies. I think the market rallies, right? It was because the market took a little bit of a swoon when it was Trump because that won't be as good of policies for us. If Biden dies, maybe that means markets rally. I don't want to say that because I'm short right now, but come on. Okay, there's a lower low in ES. And there's my fills in the treasuries. Actually, you know what? Let's let this one ride. Let's let this other contract ride because it does look like they're going to fill these guys at 16. And I kind of wonder if there's not a little blow off if they bust through it. Or heck, you might get a really fun level break setup there. Well, it looks like they're maybe not quite ready to do it. So I will average another one here. Kamala, the next president. No. I was reading all this stuff that kind of suggested that Kamala Harris didn't want the job, that she was kind of like, oh, it was dumb of me to run for president and I don't like being vice president. I don't know. That's just what I heard. I don't know how accurate it is. That's just, kind of seemed speculative. Sources on that one didn't seem too good. So they're chopping at 15.5 quite a bit, but no fills at 14.5. They are now 15.5 bid. Not enough to start attacking the 16. Nobody has hit into 16 yet. This is a good flush. Oh, now we're definitely going to get filled here at 14.5. I don't know if that's a good fill, though, because they a lot of contracts. They pulled all the way 98. Okay, well, all right. Well, I take one lot off there. Come on. There you go. Like so that one was in. Did you see that one? That actually the 15 completely pulled. That's why it went bid and I didn't get filled. Just because the sim waits for there to be volume. Are you paying attention, Ninja Trader? The simulator didn't fill my order until there had been some volume.
1 minute remaining now.
Not just because the bid ask was beyond my price. Just maybe a little, just consider it. Just think about it. Why that? How that could maybe benefit your platform. I'm still bitter about it, of course. Okay, so they did fill my other order.
10 seconds.
Oh, we get like what the natural gas supplies now. Quick session today.
32 BCF, 32 BCF, a draw on the forecast of 44 BCF.
Isn't that a rhythmic? What are you talking about? No. It's the Jigsaw simulator that does it. Both the rhythmic and the CQJ, like simulators, they're
At the natural
garbage.
Charts. Here's we are seeing some upside movement in natural gas, positive on the session.
Should have taken another one there at 14.5. Would be getting fills, good fills at 15.5. It's all right. I wouldn't mind getting my position below 120, but that would be hard. It looks like it wants to pop. Well, 19 have traded into 16. Oh, okay. So a bunch just hit there. It didn't clear. I think you put it on there. Yeah. I don't know what you're talking about, but the thing that's been bothering me in Ninja Trader is that if you put a bid in and the current offer is below your bid, then it says that you were filled. Even though no volume has gone off in the instrument at all. It should be that volume needs to go off at your price or below it, is what it should be. There you go. That was one of the best and clearest level break setups I think I have ever seen. That was just so much fun. Did I get a good price out? Yeah, it wasn't too bad. So now the question is, how much further up can they go? I'm not seeing a liquidity hole per se. So, although that kind of action can be the sort of thing that can cause it. So if I see a liquidity hole, I think in this situation I should probably be waiting, seeing if it makes another further move, and then taking it off. Spoos having the most pathetic pullback ever. It reverses here. What, the S&P 500 or the treasuries? You can't just say it reverses here, boys. You're all like, equities have bottomed, yeah, and now you change your mind 2 days over. Oh, it wasn't a bottom. Come back and say, oh, I was just taking the swing or whatever, the swing trade. Even though the other day it was, they've bottomed. Come on. I have to say, I think that the S&P 500 should be able to manage a little bit higher of a pullback than what it's done. They've only come back. Well, I guess it's maybe eight points, maybe 8 points, but it's pretty. It's not. It has nothing to do with beta. It's about calling out obvious bullshit. Do you really think that anybody here buys it? Come on. So like, again, I don't understand why this keeps happening. When people want to come in and play the Nostradamus game and try and convince people that, they're the greatest, they know everything that's going to go on, and they can predict everything for us. And then when they're wrong, they try and do all of the little saving things. Okay, like wasn't actually a bottom. We're turning around now here. Well, okay. But like, you picked the wrong channel to do it, bro. There is like a dozen trading rooms out there where you could probably go and play that game and everybody would think you're a god. Oh, show us all of your technical indicators and so on and so forth, right? This is the wrong channel to do it, man. You have to know that when you come in and you say stupid shit like that we're going to call it out as stupid shit because we're not gullible. Okay? And if you make a call and then you change it or you were wrong about it, we're going to remember it. Because the whole thing here is that a normal person will see you make a good call one time and go, oh, they're a genius, I must follow them, right? Whereas, what does Seth teach you? You probably need, do that for 5 years and then come back. You think that the S&P 500 will move up from here? But you said it was moving down. Now you're contradicting yourself. The treasuries are pushing. Look at that. They're trading like 5K a clip too, man. Jeez. How far will this one go? Because this is a move. I wish, well, I could have taken a trade in the micro 10-year. I could be short here. I don't think I want to trade it, but that would have been a good, we could have gotten, we probably could have gotten 3%. We could probably be up $60 by now. This has been like a really significant move in the treasuries. Okay, no. Okay, here's how we're gonna track it. Okay, the S&P 500 is at 39.40 right now. You're saying that the S&P 500 will move up. So a week from now, if the S&P 500 is below 3940, you are wrong. Is that fair? Is that fair? Yeah, Jacob, I think that today is a day to say there's a lot of money available for the grabbing here, right? But you can also lose a lot, right? And I think that there's kind of comes a point where as a retail trader, you kind of have to say, well, I know that the opportunity is there and maybe I could have made a good trade there, but the volatility just makes it too risky for me. So I've done that so many times. Did I move? I didn't move the goalpost. We already verified that you're contradicting yourself, right? So now I'm trying to provide yourself a way out, and you don't want to take the fair trade. Yeah, okay. Yes, you don't like that because I'm forcing you into a trade with strict parameters so that you can't come back later and BS us about what you actually meant. You're just gaslighting. No, you're the one that's gaslighting here. Do you even know what the word means? Okay. Gaslighting is like where you try and convince somebody that their perceptions and feelings about something are untrustworthy so that they don't trust themselves, right? So you're the one that's coming in and saying to us things that are completely the opposite of like what they happened. Yeah, okay. I'm just saying of any channel that you could choose to try and pull this kind of shit on, you picked the worst channel. I am not vulnerable to those sorts of things. When people try and gaslight me, it pisses me off. The instant that I'm in here and I'm like, okay, this is what happened. And then somebody says something that I know is the exact opposite of what happened, it pisses me off so much. It pisses me off so much. When my wife remembers something different from me, I can't stand it. I can't stand it. I am not vulnerable to gaslighting. I am extremely confident about myself and my perception of things. So to come in here and say like, well, but I didn't, you did. Like we were all here. We have it on video. Remember the other day when you said this is the bottom. Now you came in and you said it's actually going to go down. But now you're saying, no, actually it still was the bottom. Okay, so let's just let you take a fair trade on it right now. 39.40. You're long 39.40, right? And we can get, if you want to change the time frame on it, that's okay. We could go next week. I think that 1 week would be fair. We could do a month from now. Month might be too long. I wouldn't be surprised, to be honest with you, if we come back to like a volume profile chart on the ES. I need to like really zoom out here. Actually, we might. No, we can do it on this one. Okay. I wouldn't be surprised if we see something like this. And then in a week from now, we could maybe be here. And then, you know, even from there, it might even do this. It might not actually go back up there, right? Long Bitcoin was probably an okay trade, though. Weren't you short the other day, though? In fact, yes, yesterday you were short. No, hold up. Yeah, yesterday. Was it yesterday or was it the day before? No, I think it was yesterday. Yesterday, you were short Bitcoin. Yeah, I do. I am showing you who I am. I'm a person that is very confident in their perceptions and recollections of things. Yes. And you know why? Because I've kept track of things and I have video recordings of everything. And I've gone back and looked at these things and I found that I'm pretty good at remembering them. And that's one of the reasons why people watch, is because most of you guys here are pretty decent traders now at this point, I would say. But you know, I kind of remember things. I'm unfiltered from the way that most people are. You just get the fuck out of here, man. You can come in and say that kind of shit. You think that you can disrespect me like that? Fuck you. This is the same thing. You listen. You've been on every other channel. You think you can kind of play this underhanded game and mess with people's heads and stuff. I'm not that guy. You can't come in and just say shit like that to me. And most people would be like, well, okay, you know, what, he's having fun, whatever. No, I'm not gonna mess with that stuff. And you're distracting. You know what you've done is very distracting, to be honest, too. Right? We don't need you. So get out. Man. It's funny because I used to do this stuff all the time, right? And I would really hate it when it was like, especially since a lot of the time these people that want to come in and play that game, you get rid of them, they come back in other ways. There's been this one person on Discord that we've banned like 6 times now. I freaking swear. It's so weird, right? Like I don't know why. Again. Yeah. Anyways, I used to have that game all the time, and then, you know, I was like, no, I don't like to do that. And we got the stream to a place where we weren't dealing with that very often, but then of course we just had that here today. But whatever. Smooth brain problems? No, what the problem, Carter, is that he's gone and he's been pulling this shit with plenty of other people. And he thinks, oh, yeah, I'll pull it over here. I don't know why he decides to do it here, but I'm just saying, you picked the wrong place. Right? Because any time that somebody comes in and says, oh, I'm really good at this, you should listen to me. Here, I'm going to make a prediction. This is exactly what's going to happen. I'm always gonna like focus right in on it and be like, this bullshit. Show me 5 years. That's going to be the answer every fucking time. You get away with it every other trade room. Totally. Every other trade room, they're going to be like, oh, yeah, you were right that one time. Maybe we should follow you now. Not here. You start making calls like that, I'm immediately going to call bullshit on it. Okay, so with the Treasury here, I'm not necessarily seeing a clear liquidity hole, but we did do pretty good on that continuation trade, didn't we? I'm thinking I could justify getting out at 18. I could justify trying to hold it. The thing is that I don't really see a good reason for the treasuries to be reversing here. There is maybe a level at 118.20 half that kind of ended up mattering on the 18th. So I guess we might have some reason to think that we could get higher, but it's kind of slowing down. So I think that we're either going to take profits at 18 or wait for the next wave. Sorry, I was kind of talking about the chart and I was saying this. So in the Treasury, do you see way back here on the 18th? There's kind of this little spot at 20 half that they there was a lot of volume at the days before and then acted as resistance. So that doesn't mean that it's going to act as support or resistance today or anything like that. It just means that's like a level that kind of is a nice benchmark to say, okay, now we're higher than this, right? And then the next benchmark becomes this 118.29 half. That's awfully far away. Can we get to that today? It would be a monster move if we got to that today. ECB news is the sort of thing that could justify a move like that. 2 and 10 year. Oh, that's because I have the wrong 2 and 10 year ratio on this chart, isn't it? Oh no, maybe not. The panes are blurry even at 1080. Really? I wouldn't worry too much about what you see on every pane. I could post a screenshot for you of the desktop on Discord, but if you're interested kind of more from the perspective of, okay, what does Seth have on his screen and maybe I should have on my screen? I have a chart for all of the major components of the CME futures complex, right? So I have the treasuries, I have the equity indexes, and then I have, gold, oil, the euro, and the dollar. And I have copper, and I have 6J up. And that's basically what my screen is. The rest of that stuff, like these charts down at the bottom, I have spreads. So these are my indicators that you get from speculatorseth.com. And then these series are just cumulative delta to see, how much buying or selling there is, generally speaking. That's all that is. All you need to worry about is your own DOMs. Well, listen, I'm not taking live trades right now, so I can have fun if I want. Sometimes it's fun for me, to have that argument. But my problem is that I'll have the tendency to want to get into it over and over and over and over again, right? It's just the key thing that I want people to understand is that it takes a very large set of data to prove that the strategy you're using really truly works when you're making a claim of that nature. Okay. Anybody that comes in and says, it's going to do X, just you watch and see, just that alone is a reason to not listen to that person. Okay. Because anybody that's truly good at the market is going to understand that their ability to predict something like that is like 50-50, right? Like some of the best traders, they're like 50% winners. Okay. So he's coming in and every time I can say which way it's going to go and everything. It's total bullshit. Right. And that I think is an important lesson for anybody that's new in trading, because what I see is the new people, they totally fall for that shit, right? Yes. Ala and Spire, what is your opinion on CFM? 100%, you're talking about capital fund management, and I am a huge fan of them, and I try and read any piece of news about them that I can. So the big reason that I got into capital fund management is because Jean-Philippe Bouchot, who wrote the book Trades, Quotes, and Prices, Markets Under the Microscope, which is my favorite book, and it's all about empirical data about market microstructure. So if you really want to get into the quantitative field in regards to the DOM, that's the book that you want to read. And it's just an absolutely amazing book. And he was co-founder of Capital Fund Management. And yes, let's see here. They are a top tier hedge fund. I have seen you discussing some of the work. I saw you discussing some of the work of Bouchot. I thought you might have some opinions or insights on them. Yeah. So one key thing to note about CFM, okay, is that the force majeure their strategies that are like the award-winning strategies and everything are basically momentum strategies, commodity momentum strategies. So basically what they're doing, and I always thought of momentum as just like, okay, this is a stock, it's moving up really fast, and I jump on board, right? But that's not the way that they're doing it. The way that they're doing it is they have metrics about how much momentum there is behind different commodities, and they have a portfolio, and the ones that have positive momentum, they get in, and the ones that don't have positive momentum, they go short, or, there's different ways of doing it. But essentially it's more of a portfolio management strategy more so than anything. And it doesn't outperform the index, but it performs about the same as the index, and it has right tails instead of left tails. Because in the S&P 500, when the S&P 500 falls apart, like, you just get creamed, right? And the whole way that we deal with it in equities is you just buy and hold, right? But if you don't want to do that, and you want the advantage on the upside, then you use the momentum strategy. So I don't know if that's really something that's too useful for us sitting here scalping, but it is a very, very interesting thing, isn't it? You have a book on indicators that gave results since the beginning of time, and some are positive? Yeah. The POTUS COVID diagnosis is big news on Fox Business. I bet. Now, Allah, here's the insight I can give you, though, that will be valuable to you, okay? Most of the professional world is not really allowed to interact with us. And when they are allowed to interact with us, the interactions that they can have are very, very limited, okay? So most of these guys don't. Jean-Philippe does not have a Twitter account. So the way that you get more information about these guys and what they're doing is LinkedIn, because they can still have LinkedIn. Everybody still has a LinkedIn account. And some of them do post regular content. So Jean-Philippe does regularly visit Twitter. And so he doesn't like host his own posts every day or anything, but you can also see like what he likes and who he's following and things like that. And so I started doing that, and I have now curated a LinkedIn feed that gives me so much stuff to learn and study about machine learning. I just don't even have close to enough time to get into it all. So if you're interested in that stuff, and I think you're on the right track, Alan, that's where I would go. Is I would start trying to build up your LinkedIn. And I've had a lot of success adding people and just putting in a little message about what you're trying to do. And these people are very gracious. The thing that I've always liked about the finance community, well, the trading community specifically, is that people are totally willing to help you out. They really are. There's a limit to what they can do for you, right? But they're totally willing to help you out. So that's what I would do. I really like that guy. Like Jean-Philippe, just as a person, I find him very endearing too. I mean, he is a total nerd, man. He is a total nerd, but he's cool. He's a cool nerd, man, and he really knows his shit, right? So one of those people that just knows so much stuff about his subject that, like, it's amazing that their brain can even contain it. The book that they made is a tremendous achievement. I was at here in Salt Lake. There was a guy. He wrote a book about data engineering that came out on O'Reilly. So they had a little thing about it yesterday. And they were just kind of talking about how they were doing it, because they were saying, well, wait, I don't know all of this stuff on myself. The book was like, I know who all of the experts are, and I have the connections. And so they went and they talked to the people and then shared what they had, and then the people would give suggestions and things like that, right? And that's what trades, quotes, and prices is, right? Is you got like the top quants in the industry on the market microstructure issue, and they just compiled all of their information. And like at the end of every chapter, there's like 20 studies relevant to the issues in there, right? Real empirical data about how markets tend to behave. There's 20. Great day for crazy price action. One for the record books, for sure. For sure. Do you have a video on setting up jigsaw ladders? I just got my simulation account. You know, I should make a better video on that. You know, the way that I started things was, you know, because John Grady, he has his course, and he talks a lot about that sort of a thing. But let me give you a quick rundown, and then maybe we can turn this into a full video later. All right. So the first thing is that a really significant part of trading with the DOM is being able to see correlated assets. You know, when you have a bunch of charts like this over here, you know, that's cool. I can kind of see like they're all kind of going up, and I really like being able to, you know, when my cursor is on one chart, I can see it on all of the other charts too. That's cool. But I can't see all of that at once, you know, like in my peripheral vision. When I'm watching here on the treasuries, I can keep my eyes right here, right? And I can still kind of see out of the corner of my eye this and this to see, okay, we are flattening a little bit, right? So whatever asset that you're trading, you're going to want to find the most related assets to it and put those up as well. So in this case, we're trading the 10-year treasury. So I also have the 30-year and the 5-year over here. Okay. If you were trading equity indexes, you know, I only just have the S&P 500 over here. And no, this trade is not necessarily going so great. I think that I will stop it out up here. Then you would want to have the NASDAQ and the Dow Jones up as well, right? And you just kind of want to see how they trade relative to each other. And you might see a situation where this one moves and this one doesn't move or doesn't move as much, and you want to make note of those things because some of it is kind of a bit of like a statistical arbitrage sort of a thing with the related assets, right? So that's the first thing, is get a bunch of DOMs up so that you can recenter things and then just watch out of the corner of your eye, you know, how the related assets move. Okay. The next thing that you're going to want to look at is the clear trades timer interval.
July 25th, settle on July 28th.
So this basically says these two center columns are the market orders hitting into the limit orders, right? And if we tick up and we're there for a little while and then we tick back down and then we tick back up again, it will like reset that center column so that you can see each time that it ticks up how much volume did it take to go. But you get these situations where it kind of flickers up and down. You don't want it to reset every time. So there's a timer. The default is 2.5 seconds for how long before it will reset that column. A lot of people like to set that to 10 seconds, to 10,000. So that's the next most important setting that I would add in Jigsaw. The next one is if you're trading a relatively volatile market like the indexes and NASDAQ, etc., I would really highly recommend having this momentum tails indicator on. That's basically what that does is you'll see when it moves, you can kind of see a trail behind the price to see how long ago it was trading that price. And that really helps you get an idea of like how fast that market is moving. Okay. So that's important. You might want to turn on the bid and ask snapshot columns. I don't use them, but a lot of people find those useful. The profile columns as useful. A lot of that is just going to depend on how much room you have. Yeah, it stopped out. A lot of that's just going to depend on how much room you have on your screen. But you know, you can have the text super, super small if you want, right? So then you could fit all of them on there if you really wanted. If you're on Rhythmic, you want to increase your market depth higher than 10, probably, because that's one of the advantages of Rhythmic. And then the other one here, okay, so two other things that I would recommend then. This is kind of getting more into your trades. Number one, in the trade column, I would have show P&L and include closed PML checked. So what include closed P&L does is Do you notice how my average position was at 16? But because I had taken some sequential profits, my theoretical break even is way down here at 12.5, right? So if you work with multiple contracts and you take sequential profits, this kind of shows you the difference between your theoretical break even and your actual average. Okay. So that's really useful if you're trading multiple contracts. And then the next thing is here in this trading thing, you might want to use some of these settings here on this trading screen. So one is reduce Smart Q font. That way, when you put a limit order, the font that it uses is a lot smaller. Oh, by the way, I don't need that anymore. Close that. So that's really, really nice. The Smart Q font thing. Another thing is close outstanding orders when position is closed. So sometimes I might be putting a bunch of orders down in here and I might have stops up here. And then all of a sudden I go, oh, I don't want to be in this anymore. So I either I click out of it or I hit the flat button over on my, my little control that I got over here. Right. Okay. I don't want those other orders to still be out there because they could get filled really, really quickly. So the close outstanding orders when position is closed setting is really useful, right? Recenter on new position is also really useful. So those are like the key settings that I would look at, that everybody should look at. I don't know if is there anything I missed, guys? One thing I noticed early on was getting in trades late, being proactive instead of reactive, taking the initiative. I was taking profits where 90% were losing. Yeah. I don't know if I really want to go into this whole thing. Hold on a second. Where did my... It fell down. It's time for me to get going. It's 9:05. We'll talk about that a different day. Okay? But I got to get going. Okay? So, stay profitable, friends.